Welcome to FinFluential.
Look at the fun we're having.
Okay, boys and girls, put your pants on. It's a video clock. Now, I didn't wake up at 4:47 a.m. Australian time for nothing. So if you could kindly smash that like button and then buy me a dirty chai, no sugar, milk or water, extra shot, raw chai latte, and express ship to 666 Butt Street, Buttress Hill, 6066, Peachy. Now, on today's video, we're going to be buying the dip, because that is the only way you make money in this market unless you're a regulated Australian broker still charging $3 per fucking trade. Now let's do some quick maths.
2 + 2 is 4, -1, that's 3, quick maths.
I bought some stock yesterday. I paid a $3 commission. $3 into my retirement account at inception would be $23.55 today. $23.55 today could have bought one Berkshire Hathaway share during Buffett's takeover. Each share would be worth $641,000 today. That's 978,000 Australian pesos. The absolute criminals in this world. Thursday rant over. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out, guys. Let's get into it. This is the daily heat map of the S&P 500. A lot of green. The S&P 500 just had its best day in a year. In the same week, we also had the worst day in a year. So very volatile times. And today's rally was an everything rally, really. I mean, financials performed, so too did technology. The big boys, Nvidia, Microsoft, Apple, Google, Meta, Amazon, Tesla, they all participated. We saw the same action in industrials, real estate, energy. There wasn't much to say other than money going into equities. It was risk on, but we did see some constructive stuff for the bull case. The one thing I've been harping on this entire week is that if we are to see bullish action to the upside, that needs to coincide with defensives getting sold. And that's actually what we started to see here with utilities. To see utilities do what they did today, very interesting day of trade. Now, utilities was actually positive on the day. This actually has to do with Vistra Energy. They dropped their earnings. They were up 6-7% at 1.8% for the day. Excluding Vistra Energy, utilities was negative. So we saw a rotation out of utilities, these defensive sectors. Look at staples, right? Even though it was positive, it was at the bottom of the sector analysis chart, and the market bought cyclical stocks that would do better on a stronger macro backdrop. Tech, industrials, discretionary, energy, comm services, these were all up 2%, and tech leading the charge up 3.8% respectively. Even stuff like financials and materials, rate sensitive, highly cyclical sectors up 1.6% each. And the defensive sectors, which led the charge in the last week, yes, they were green today, don't get me wrong. And on a risk on day where you just pour money into equities, buy everything, you have to look at the nuanced data. And this is telling us we're seeing a rotation out of defensives into cyclicals and the rest of the market. Now, this may just be a one-day event. We need to see continuation and more of the same stuff like cyclical sectors, tech, industrials, discretionary, outperforming, and subdued price action in utility staples. If we continue to see that, it's very likely we've put in a bottom and then we move higher from here. We also saw the same price action here in small caps, mid caps too, growth core value, everything just rallied today. But we did see large growth was the best performing factor, with the Nasdaq 100 up 2.98%. Small caps and the S&P 500 tracked each other like for like. They gained 2.32, 2.38 respectively. The RSP, the broader market, the equal weight S&P 500 up 1.85%. And all of this bullish price action stemmed from upbeat initial jobless claims that we got today. We beat the forecast. The expectation was 241. We got 233,000 in the context of the NFP numbers we got last week. This is a huge positive. And then another piece of news that really added to sentiment today was JP Morgan coming out and saying 3/4 of the global carry trade is now unwound. The majority of the move behind us. Just yesterday, they came out and said 50% of the move is unwound, which means that a lot of the liquidation we saw because of the yen carry trade is now done. JP Morgan believe that the majority of participants are now net long, and they believe this market headwind is now behind us. Now, on the back of today's stronger economic data, we actually did see yields rise. The 2-year yield was up 1.92%. and the 10-year yield was up 1.24%, indicating a stronger economic backdrop. Now, it's very clear that the yen carry trade was keeping metals subdued with the economic data we saw and yields falling like it did dramatically last week. we should really see stuff like gold and silver rocketing as a hedge, and that simply wasn't the case last week. And we did see the start of that today. Gold was up 1.8%, the silver was up 3.57%, a huge move there in silver. Crude was up 1.28%, but I think there's a whole bunch of other factors affecting crude. So we should see more healthy market momentum come into the market now that the Japanese fuckery is behind us. The dollar actually did gain today, but pretty much flat, up 0.003%. But it wasn't just the macro factors that were affecting the entire market. There was actually a lot of good stuff on the technical side that came together today. Stuff like solid market breadth. The market's just been oversold. You see just on a basic daily RSI, and we bounced. And we also failed to take out the previous day's lows. If we actually just zoom in here, right? I know we're getting really nuanced, but we put in a low right here, then we put in a higher low on this day, then we actually just put in a higher low on this week, and now another higher low. In the context of us rallying off the put support was right here, remember? The put support moving up and us retaking the gamma flip. Yes, we did sell the gamma flip quite a lot, but us now retaking it, closing above it, that's very, very constructive, especially with a bullish candle. You can see we pretty much closed at the high of the day, a little bit of selling at the top, but inconsequential, and we officially closed in positive gamma above the 5300 strike. That is bullish. What we do want to see now is just consolidation. We want to see consolidation in this area. If we can get consolidation in this area, that does open up the upper bounds for the S&P 500. But if we do break below the 5300, kiss this tailwind goodbye, and that probably means we go to the put support. You guys know how we play. Above the gamma flip, we're bullish. Below, we're bearish, but not necessarily taking shorts, just looking to get long for what is to come. And above the 5300, that opens up the core resistance, which is now at 54.58. Expect all of this to move up. If we get a move up in the gamma flip, as well as the put support tomorrow, that's often a bullish sign. And if we can then go close above the higher gamma flip, that probably means we're back on in the market. Now do take into consideration, guys, that August, September, we are in a seasonally weak period of the year. If we do continue to just trade sideways, let's say, sort of in this range, don't be surprised. We are in a seasonally weak period of the year. And what we really want to be doing in this time of the year is building our cash reserves and buying stocks, ETFs, and equities that we like, positioning ourselves for the end of year rally, which will ensue. So for the next couple of days, there's a few things you need to watch. Firstly, the 5300 gamma flip. We stay above here, that's constructive. We move higher, that's constructive. I would actually look at stuff like utilities, right? XLU, that's the ticker, as well as XLP, staples. If we see subdued action in these two ETFs with stuff like the Nasdaq 100, the S&P 500, as well as the RSP, the equal weight rallying, if we get that while these actually pull back, that means it's risk on, and we are starting to see a continued rotation. But if we see a bid up in these names right here, while the market trades sideways, that's still telling us that there's market worry underneath the surface and that seasonal factors are still at play. But as long as we're above the 5300 right now, I'm buying dips, selling rips to the 5485 area, and buying stocks like the Nasdaq 100, QSML, PayPal, Paycom Software, and Google. Now looking at the AAI sentiment survey, very interesting to see the changes in sentiment. We saw a huge uptick in bearish sentiment votes, but not the same in bullish sentiment votes. So there is still bullish sentiment overall. What we really saw is people in this neutral camp right here pick sides, either to the bullish side or the bearish side, and we see a very weird dynamic. Bullish sentiment is above the bullish historical average, and bearish sentiment is also above the bearish historical average. Sentiment on both ends of the spectrum in absolute extremes, and that's why we're getting the volatility we're seeing in the market right now. But diving into earnings, and not S&P 500 earnings, we're going to look at the Russell 2000, something we don't look at too often, but we do have the data, the most up-to-date data. Now do take these earnings with a grain of salt, guys. Only 611 companies have reported in the Russell 2000, less than half, but we could still look at it nonetheless. Small caps, the IWM, Russell 2000 reporting 19.4% earnings growth on 0.2% revenue growth. It's a little bit better when you exclude energy and a little bit better on the earnings side at the start of earnings season. but not so much on the revenue side. So earnings looking good, revenue looking subpar, and only 67% of Russell 2000 companies are beating analyst expectations. So very mixed earnings right here for the Russell 2000. We're going to see how the market reacts to these once we get through this market volatility. However, small caps are trading at fairly reasonable valuations. Now, they are actually trading above average on most metrics, but these valuations right here actually exclude negative earnings. So this right here is more akin to the S&P 600. And what you see is on a trailing PE basis, the Russell is fairly valued, same on a forward PE basis and a price to book basis, slightly overvalued, 4%, 5%, I think inconsequential. Where the Russell 2000 looks really expensive though is on a price to sales and price to earnings growth basis, as well as an enterprise value to free cash flow. Depending on what metrics you want to look at, the Russell may be overvalued, might be undervalued. I think the truth is somewhere in the middle, and you could call the Russell 2000 right now fairly valued. And the small cap forward price to earnings ratio is at about the long-term average, and that's not necessarily a bad thing, because a 15 PE ratio for the Russell suggests 9% annualized returns for the next 10 years. That's very, very good. The S&P 500 long-term average is about that, 9 to 10%. So to get that in the Russell 2000 with a diversified group of stocks that might be partially uncorrelated to something like the S&P 500 is very healthy to have. And I still think, if you're a very long-term investor looking at retirement, this is where you retire your capital. Looking at the S&P 500 and talk about irrational market behavior. This red line right here is S&P 500 forward EPS estimates. This blue line right here is actually the S&P 500 price action, and we can see as the S&P 500 has actually pulled back, earnings estimates continue to actually saw a fundamental divergence from price, telling us that this right here, what we're seeing is actually based on all of the factors excluding earnings. At the end of the day, everything will come back to earnings, and if earnings estimates hold up, the S&P 500 will recover back to all-time highs. And all of this right here is based on the macro, partially what we're seeing with Japan and market liquidation as a result. This right here is telling us the fundamental picture is looking really good, and you do just want to buy the dip unless we actually see earnings estimates pull back in a very material way. The truth of the matter is EPS estimates normally lead S&P 500 price. We're not seeing that right now, but the future holds all of the answers, and this recent volatility is actually opportunity, because we have the data right here, S&P 500 performance around major VIX spikes. This is when we get the VIX spike right here, and 50 weeks later, 1 year later, you can see average S&P 500 returns 10%. On the high end, you're looking at about 20%. At the very low end, we're probably looking at 2 to 3% gains in the S&P 500. I think that's great risk-adjusted returns, and that's why I've been saying you want to buy the dip, you want to look 12 months out, you want to have a dollar cost average strategy in place, even if the market goes lower. And I do think we're going lower. I think the S&P 500 is probably going to bounce at around the 5,000 area. I think we're going to see a lot of volatility in the meantime. There's going to be upswings, there's going to be downswings. That tends to happen this time of year. That tends to happen when volatility spikes. You could actually see normally even up to 4-5 weeks after the VIX spike, we actually get negative returns in the S&P 500. But this is where we normally trough 3 to 4 weeks later, and it's another 3 to 4 weeks before we break even around the 7-8 week mark. That's when we see positive returns in the S&P 500. That would take us to just after the election, and then we continue the rally onward and upward in the S&P 500, especially if earnings estimates hold up. Now, looking at earnings, we had a fairly big week of earnings. To be honest, I thought earnings season this week was actually really good. Today we had a big player, Eli Lilly, report. I actually went to go have a look at their earnings. They beat on the top line, bottom line. Margins look healthy. The new diabetes drug is showing progress. Fantastic earnings from this name right here. Guys, Vistra Energy, a big player in the utility space, actually reported great earnings today. It was up 6% during today's trade or something like that. It was up a lot. I also had a look at Datadog's earnings. I think they beat on the top line and bottom line. Just guidance kept the same. Guidance was kept the same, so the market liked what they saw there. ELF, I didn't have a look at the earnings, but I saw a market reaction of about down 6%. With Thursday done, that is pretty much the majority of S&P 500 Q3 earnings to report. Are still a couple of big names. Stuff like Adobe, Nvidia, Costco, but the majority of S&P 500 earnings is behind us. Diving into some macro, this is some very interesting data from BofA. They say a Venn diagram of a soft landing. This is where we achieve the soft landing, guys. If hiring is slowing because it's catching up from below, layoffs remain low, and growing labor force pushes the unemployment rate higher, then the probability of a soft landing remains high. That's why we track unemployment on this channel so often. And looking at today's jobless claims data, and today's figures beat expectations. We got 233,000 initial jobless claims. The forecast was 241, but you have to put this figure into context with previous claims we've gotten in the last couple of weeks, as well as the NFP data we just got. With the terrible NFP data we just got, you would expect initial jobless claims and continuing claims to surge. That is simply not what we saw, telling us that probably a lot of the NFP data we saw last month was weather related. And if it had any long-term effects, we would see a huge spike in initial jobless claims. And that's why the market rallied today. It was putting the macro into perspective and saying, hey, things are not quite as bad as some of the data suggests. And here's a couple of other consumer sentiment measures. The share of loans in foreclosure remains very low at 0.46%, some of the lowest levels we've ever seen. Almost as low as what we saw here during the COVID situation. Household formation is above the long-term trend. Personal bankruptcy filing rates are hovering over multi-decade lows. Very interesting data. There's just a huge gap right here because of the GFC. That's so interesting. Financial obligations, including debt payments, lease payments, property taxes, and rents, relative to incomes, are staying low by historical standards. And our US housing affordability index remains at record lows.